Hey everyone. Have you ever seen a stock lose a huge chunk of its value, even though the company keeps announcing new business deals? That's exactly what's happening with Redwire, and many investors are trying to figure out whether this is a golden buying opportunity or a warning sign that shouldn't be ignored. Over the past several weeks, Redwire's share price has been under intense pressure. The decline has surprised many investors because, on the surface, the company continues to make progress with new contracts and expanding its business. Yet instead of rewarding the stock, the market has pushed it lower. So what exactly is causing investors to sell? Is there something fundamentally wrong with the company? Or is this simply a case of market psychology taking over? Let's break everything down in simple terms. The biggest reason behind Redwire's recent decline came from an announcement that immediately caught Wall Street's attention. The company revealed plans to introduce a new fundraising program that gives it the ability to raise as much as $500 million by selling additional shares into the market over time. Now, raising capital isn't automatically bad. In fact, many fast-growing companies regularly issue new shares to finance expansion, develop new technology, complete acquisitions, or strengthen their financial position. The problem lies in how that money is raised. When a company creates new shares and sells them, existing shareholders suddenly own a smaller percentage of the business than they did before. Imagine cutting a pizza into 8 slices and owning 1 slice. If the pizza is suddenly cut into 16 slices, your single slice becomes a much smaller portion of the whole. That is essentially what investors mean when they talk about dilution. Because of this, many shareholders worry that, even if the business grows, each individual share may represent less ownership than before. This concern alone can trigger significant selling pressure, especially when investors believe more shares will continue entering the market. Another factor that likely influenced investor sentiment is the message behind the fundraising itself. Some traders interpreted the move as management believing the stock price was high enough to justify selling additional shares. Whether that's actually true is impossible to know, but perception often matters just as much as reality in the stock market. If investors think executives believe the current valuation is attractive for issuing new stock, some decide to lock in profits before additional selling pressure appears. That creates a cycle where fear fuels even more selling. But Redwire wasn't the only company experiencing turbulence. The entire space industry has recently gone through a major shift, largely because of one event investors had been waiting for: the public market debut of SpaceX. For months leading up to that highly anticipated milestone, enthusiasm surrounding space-related companies reached extremely high levels. Investors were excited about everything connected to the commercial space industry, and many stocks in the sector benefited from that optimism. As excitement built around SpaceX entering the public markets, money flowed into space stocks across the board. However, once the event finally arrived, the situation changed dramatically. This phenomenon is actually quite common in financial markets. Investors often buy stocks ahead of a major event because they expect excitement to continue. But once the event actually happens, many choose to take profits. Others sell existing investments simply to free up cash for the newly available opportunity. That appears to have happened across several space-related companies, including Redwire. Some investors likely shifted their money directly into SpaceX after its debut. Others simply reduced exposure to the broader sector because the excitement that had fueled previous gains started cooling off. The result was widespread weakness throughout many space technology stocks, and Redwire became one of the biggest casualties. At the same time, the defense sector wasn't providing much support either. Because Redwire operates in areas connected to aerospace and defense, broader weakness in defense-related investments also weighed on investor confidence. When multiple sectors experience selling pressure simultaneously, companies positioned between those industries can sometimes face even greater volatility. But here's where the story becomes interesting. Despite all the negative price action, Redwire actually continued making positive business progress. Early in the month, the company announced a partnership involving biotechnology research aboard the International Space Station. The project focuses on growing strawberries in space while testing specialized soil enhancement technology developed for use in microgravity conditions. At first glance, growing strawberries in orbit may sound unusual, but research like this serves a much bigger purpose. Scientists are working toward creating sustainable food production systems for future long-duration space missions. If astronauts are expected to spend months or even years traveling through space or living on the Moon or Mars, They will eventually need reliable ways to grow fresh food instead of depending entirely on supplies launched from Earth. Experiments like these help researchers understand how plants behave in space and what technologies can improve future agricultural systems beyond our planet. For Redwire, participating in these kinds of projects further strengthens its position within the expanding commercial space economy. Then, toward the end of the month, the company announced another contract involving a completely different part of its business. This time, Redwire secured an agreement to provide its Penguin Mk2.5 vertical takeoff and landing aircraft to the Taiwanese Coast Guard. This demonstrates something many investors sometimes overlook. Redwire isn't dependent on just one product or one customer. The company operates across multiple markets, including aerospace technology, defense solutions, advanced engineering, robotics, space infrastructure, and unmanned aerial systems. Diversification like this can become an important strength over the long term because revenue doesn't rely on a single project succeeding. Unfortunately, positive business announcements weren't enough to overcome broader market concerns. As the calendar turned into July, selling pressure continued. Even without any major negative company-specific headlines, Redwire's stock kept moving lower. Part of that weakness also reflects the overall market environment. When investors become more cautious, they often reduce exposure to higher-risk growth companies first. Stocks tied to emerging technologies, including artificial intelligence, space exploration, robotics, and advanced manufacturing, usually experience larger price swings than mature businesses because much of their value depends on future expectations rather than current earnings. Even relatively small changes in investor sentiment can therefore produce large movements in share prices. That appears to be exactly what happened here. While the broader stock market experienced only modest declines, speculative growth stocks generally faced much heavier selling pressure. For Redwire, this created the perfect storm. Concerns about shareholder dilution. Changing investor enthusiasm following SpaceX's public debut. Weakness across space technology companies. Pressure within defense-related stocks, and a broader move away from speculative investments. All of these factors combine to send shares significantly lower. Does this automatically mean Redwire is a bad investment? Not necessarily. It's important to separate stock price movements from business performance. Markets often react emotionally in the short term. Fear, uncertainty, and shifting investor expectations can push prices well below what some believe a company is actually worth. On the other hand, lower prices don't automatically mean a stock is undervalued either. Investors will continue watching several key questions. Can Redwire effectively use the new capital it raises? Will future contracts translate into stronger revenue growth? Can the company improve profitability over time? And perhaps most importantly, can investor confidence return once concerns surrounding dilution begin to fade? Those questions will likely determine where the stock heads over the coming months. For now, one thing is clear. Redwire remains a company with ambitious technology, growing opportunities, and exposure to industries that many believe will become increasingly important over the next decade. However, it also faces real challenges that investors can't ignore. The recent sell-off shows that Wall Street is currently focusing more on near-term risks than long-term potential. Whether that creates a buying opportunity or signals additional downside is something every investor will have to decide based on their own research, risk tolerance, and investment strategy. As always, remember that short-term volatility is common in emerging industries. The biggest winners and losers often experience dramatic price swings before the market eventually settles on their long-term value. Only time will reveal whether Redwire's recent decline becomes a temporary setback or the beginning of a much larger trend. This is not financial advice.